The other big issue today, the stock market. Rough day to say the least. If you took a look at your 401k or any of your investments, first of all, I'm sorry, but tap the brake for a second. Let's first of all look at how the market closed today. Dow is down big time, over 1,000 points, 2.5%. S&P down 3%. NASDAQ closing down just 3.5%. So the big question, as we all take a collective deep breath, because we're in this together, what does it mean for you and your money? Our Ken Molesina sitting down with a financial expert to help us make sense of a steep downturn on a single.
Yeah, and Doug, the good thing about experts like Jim LeCamp here is that anytime something like this happens, we can lean on you for a little bit of perspective on what's going on here. So let's talk a little bit. Jim LeCamp, by the way, financial expert and senior vice president over at Morgan Stanley. For people who are worried, and there are many of us, right, 401k investments, other stock investments, what should they be doing right now?
Okay, so people have kind of forgotten that these things are pretty normal and they happen quite a bit. Now, today was a pretty big move, right? Yeah. But we've been since the fourth quarter of 2021 without even a 2.5% correction. So this correction took a long time to get to. Stocks kept climbing, and when you do that for a long time without any sort of a pullback in the market, usually the pullbacks are a lot sharper and fiercer, but they are normal and they are part of the process. If people want to really dig down deep, the real concern is that now we're going for a hard landing instead of a soft landing in the economy. That a lot of the economic data that we've seen lately has been weaker. And a lot of people are now worried that the reason the Fed has to cut interest rates now is because the economy is slowing down. And if it is, it's going to be harder for these companies to make money, and so the value of the stock market starts to drop a little bit. But it is normal.
So you stay put then? Breathe.
Everybody's different, right? Some people are more tactical and they like to time in and out. But for most people, your 401k, these drawdowns are healthy for you because you're buying in every month. And you're buying when prices are low. Remember the financial crisis in 2008?
Yeah, sure.
That was a great time to be buying stocks. This in comparison to 2008, is nothing at all. And it could turn into a little more, but the market tends to do okay in presidential election years.
I wanted to ask you, Jim, because we know that on Friday what really set this in motion was this bad jobs report that came off. And it set it off really globally, right?
Yes.
Why is the jobs market, why is that such an important indicator or gauge for folks who are following this?
Because what we've seen is that consumers have kept this economy afloat and the stock market afloat for the last couple of years. But consumer savings has wound down. All the excess savings that we had from COVID, consumers have spent that money. So now what people are worried about is most of the jobs created over the last 12 months have been part-time. Now these employers are starting to lay off the part-time workers, and that's a real problem. And if consumers don't have jobs, they don't have money to spend, all these companies that are out there showing really nice profits over the last couple of years aren't going to have those profits anymore, and we have to reset prices a little bit.
Okay. Well, Jim LeCamp, thank you so much for coming in here, answering some questions and sharing some perspective. Very important for us here as we collectively, Doug Dunbar, all kind of take a breath right now is kind of the message that I'm hearing here.